All right, let's get right into it, because what a week it has been for anyone watching their crypto portfolio. Just when it seemed like Bitcoin was comfortably cruising in the fast lane, holding strong around that impressive $90,000 mark, the market decided to slam on the brakes. On Monday, a wave of selling pressure hit with almost no warning, sending the price tumbling down. In a matter of hours, we watched thousands of dollars get wiped off its value, with the price dipping all the way to around $87,000 and even briefly touching the 85,000s. This wasn't a gentle correction. It was a sudden, sharp drop that left a lot of newer investors feeling rattled and asking what just happened. This is the kind of volatility that makes headlines and gets everyone talking. This sudden downturn wasn't just a Bitcoin problem. It was a contagion that spread across the entire cryptocurrency market like wildfire. Ethereum, the second largest player in the game, also took a significant hit, falling well below the critical $3,000 psychological support level. Other popular coins, from Solana to XRP, followed suit, with many of them posting losses between 4 and 7%. It was a sea of red across the board, a clear signal that this wasn't an isolated issue with one specific digital asset. Instead, it was a broad market reaction, indicating that larger, external forces were at play, pulling down the entire crypto ecosystem along with its kingpin, Bitcoin. When you see a coordinated drop like this, it's rarely because people just woke up and decided they don't like crypto anymore. This is the work of big money moves and macroeconomic fears. The total value of the entire crypto market, which was sitting pretty above $3 trillion, took a noticeable haircut. The sentiment shifted almost overnight from cautious optimism to outright fear. In fact, the Crypto Fear and Greed Index, a tool that measures market emotion, plunged into the fear territory, telling us that investors are getting extremely nervous. This is a classic risk-off scenario, where people flee from what they see as speculative assets and rush toward things they consider safer, like cash. So, the big question on everyone's mind is simple. Was this just a temporary speed bump, or is it the beginning of a much bigger slide? The fall from $90,000 to $87,000 might not seem catastrophic in the grand scheme of things, especially for an asset known for its wild swings. However, the speed and context of the drop are what's causing concern. It broke through several minor support levels with ease, signaling that the sellers were in firm control. Now, the market is holding its breath to see if the bulls can muster the strength to defend the next critical price level, or if we're about to witness another chapter in Bitcoin's dramatic and unpredictable story. One of the biggest lessons for crypto investors over the last few years is that Bitcoin does not live on an island. For a long time, people thought of it as a completely separate, uncorrelated asset, but that's just not the reality anymore. When traditional markets, like the US stock market, get nervous, that anxiety often spills over directly into crypto. That's exactly what we saw leading up to this week's drop. Last Friday, the US stock market experienced a significant dip, with major indices like the S&P 500 and the Nasdaq closing in the red. This created a powerful risk-off sentiment, where big investors decided to reduce their exposure to anything they deemed risky, and unfortunately, crypto is still at the top of that list for many. This connection between stocks and crypto has become incredibly strong, especially during times of uncertainty. Think of it this way. The same large institutions, hedge funds, and even retail investors who are buying stocks are also the ones buying Bitcoin. So, when they get an order from the top to de-risk their portfolios, they sell everything: stocks, speculative tech, and yes, their crypto holdings. The logic is simple. If the economy might be heading for a downturn, it's better to be holding cash than volatile assets. The sell-off on Wall Street last Friday was a clear warning shot, and by Monday, that fear had fully infected the crypto markets, triggering the price drop we all witnessed. This isn't just an American problem either. It's a global phenomenon. Markets all around the world, from the US to India, are feeling the pressure. We're in a strange place where many global stock indices are hovering near their all-time highs, which sounds good, but it also makes them vulnerable to a sharp correction. Professional traders get nervous when everything looks too good to be true. Add in the fact that it's the end of the year, a time when trading volume typically thins out as people go on holiday, and you have a recipe for exaggerated price moves. With fewer buyers in the market, even a moderate amount of selling can have an outsized impact, pushing prices down further and faster than usual. So when you see Bitcoin's price falling, it's crucial to look beyond just the crypto-specific news. You have to be a bit of a detective and look at the bigger picture. What is the US Federal Reserve doing? How are stock markets in Asia and Europe performing? What is the overall mood among global investors? Right now, that mood is one of caution. The optimism that drove markets higher for much of the year is being replaced by a fear of the unknown. And in that kind of environment, high beta assets like Bitcoin are often the first to get hit. Until that broader global sentiment improves, crypto might find it difficult to regain its upward momentum. Now, while the US stock market certainly played a role, there's an even bigger, more specific fear looming over global markets right now, and it's coming all the way from Japan. For years, the Bank of Japan has kept its interest rates at or near zero, making it incredibly cheap to borrow money in their currency, the yen. This created something called the yen carry trade. Big investors would borrow massive amounts of yen for next to nothing, convert it into other currencies like the US dollar, and then invest that money into higher yielding assets around the world, including US stocks, bonds, and, you guessed it, Bitcoin. This has been a huge source of liquidity, propping up asset prices globally. But here's the problem. There are growing whispers and widespread fear that the Bank of Japan is about to change its policy. Their next meeting is scheduled for December 18th and 19th, and the market is terrified that they will finally raise interest rates for the first time in nearly a year. Even a tiny increase, say by 0.25%, would be a monumental shift. If that happens, it suddenly becomes more expensive to borrow yen. This would cause that entire yen carry trade to unravel, and fast. Investors who borrowed yen would have to quickly sell their global assets, their stocks, their crypto, to get the cash needed to pay back their loans before the cost of borrowing spirals. This isn't just a theoretical fear. We have seen this movie before. Historically, when the Bank of Japan makes significant moves with its monetary policy, the Bitcoin market reacts violently. In fact, on previous occasions over the last couple of years, when Japan even hinted at tightening its policy, Bitcoin's price has suffered drops of 25 to 30%. If a similar reaction were to happen this time, a 30% drop from the recent highs could theoretically send Bitcoin's price spiraling down toward the $60,000 zone. This is why every serious trader on the planet has their eyes glued on the Bank of Japan's upcoming decision. It's a financial domino that, if it falls, could set off a chain reaction across all risk assets. The fear of this potential rate hike is what's causing the risk-off sentiment we're seeing everywhere. It's not just about the direct impact of the carry trade unwinding. It's about the psychological shockwave it would send through the financial system. It would signal the end of an era of ultra-cheap money from one of the world's major central banks, pulling a massive amount of liquidity out of the global economy. This is why markets in the US, India, and Europe are all on edge. They are all connected to this web of global capital flows, and a policy change in Tokyo could tighten the purse strings for everyone, making it much harder for assets like Bitcoin to sustain their high valuations. In the world of trading, some price levels are more important than others. They aren't just random numbers, they are major psychological and technical battlegrounds where bulls and bears fight for control. Right now, for Bitcoin, that all-important line in the sand is the support zone between $86,000 and $87,000. This isn't just a recent support level. It happens to coincide with a hugely significant technical indicator known as the 21-month moving average. Think of this moving average as a long-term trend line that has historically marked the difference between a healthy bull market and a devastating bear market. As long as Bitcoin stays above it, the long-term uptrend is considered intact. The reason traders are watching this level with such intensity is because of what has happened in the past when it has failed. A monthly candle closing below this 21-month moving average has been a historically reliable signal that much more pain is on the way. It's like a dam breaking. Once the water breaches the wall, the flood that follows is often severe. If Bitcoin were to decisively lose this support and close the month of December below it, it would flash a major bearish signal to technical analysts all over the world, likely triggering another wave of automated and panic-induced selling from traders who follow these charts. If this $86,000 support level breaks, the question becomes, how low could it go? Looking at the charts, the next major area of historical support isn't until you get down to the $55,000 to $60,000 range. That would represent a significant further drop from current prices and would certainly feel like a true bear market for anyone who bought in recently. This is because there is very little price history or support between the current level and that lower range. The price moved up so quickly through the $60,000 and $70,000 zones that it didn't build a solid foundation of buyers. So, if it falls, it could fall just as quickly through that empty space, like an elevator with a snapped cable. On the flip side, if the bulls can successfully defend this $86,000 to $87,000 zone and the price bounces strongly from here, it would be an incredibly positive sign. It would show that despite all the macroeconomic fear and selling pressure, there are enough buyers willing to step in and hold the line. A successful defense of this critical support could be the foundation for the next leg up, potentially reigniting the bull run and pushing Bitcoin toward new all-time highs. But for now, everything hangs in the balance. The market is teetering on this knife's edge, and the battle for this crucial price level will likely determine Bitcoin's direction for the next several months. For those who are new to crypto, this kind of sudden gut-wrenching drop can feel terrifying. But for anyone who has been in this market for a few years, it's a familiar feeling, a case of déjà vu. Bitcoin has a long and storied history of massive bull runs, followed by brutal, prolonged corrections. Understanding these past cycles can provide some much-needed perspective during times like these. The key is to look at what happened when Bitcoin broke through similar long-term support levels in the past, like the 21-month moving average we are testing right now. History doesn't repeat itself exactly, but it often rhymes, and the rhymes in Bitcoin's history can be quite loud. Let's take a trip back to 2018. After the spectacular bull run of 2017, where Bitcoin surged to nearly $20,000, the price spent most of the following year bleeding out. For months, it found a shaky floor around the $6,000 level. Many people thought that was the bottom, the absolute lowest it could go. But then, it decisively broke below that critical support, which also corresponded with its long-term moving averages. What followed was a catastrophic collapse. In a matter of weeks, the price was sliced in half, plunging all the way down to around $3,000. This period, known as the crypto winter, washed out countless investors who thought the pain was over at $6,000. We saw a similar pattern play out more recently in 2022. After hitting its all-time high of around $69,000 in late 2021, Bitcoin entered another corrective phase. For a while, it seemed to find stability around the $40,000 mark, and again, many hoped the worst was behind them. However, once it broke below its key long-term support levels, another trapdoor opened. The price cascaded downward, eventually bottoming out near $15,000 amid a series of industry collapses like FTX and Terra Luna. In both 2018 and 2022, the lesson was the same. Losing a multi-year support level is not a small event. It signals a fundamental shift in market structure from a bull to a bear trend, and the subsequent downside can be far greater than most people expect. This historical context is precisely why traders are so fixated on the $86,000 to $87,000 level today. It's not just a number on a chart, it's a level that carries the weight of past market cycles. The precedents set in 2014, 2018, and 2022 are clear reminders of what can happen when long-term uptrends break. While the fundamental picture for Bitcoin is arguably stronger than ever, with ETF approvals and institutional adoption, the technical patterns are flashing a serious warning sign. These past examples serve as a cautionary tale, reminding us to respect the risk and to understand that if this crucial support fails, the path to 60,000 or even lower is a very real possibility based on historical performance. Amidst all this fear and the sea of red candles on the charts, there is a fascinating subplot unfolding behind the scenes. While many retail investors are panicking and selling, some of the biggest players in the financial world, the so-called whales, are quietly accumulating more Bitcoin. We are seeing clear evidence that large institutions are using this price drop as a buying opportunity. For example, the US-based spot Bitcoin ETFs, which are a direct gateway for institutional money to enter the market, continue to see net inflows. On Friday, even as prices were beginning to wobble, these funds saw nearly $50 million in new money come in, with giants like BlackRock leading the charge. This isn't just limited to Wall Street funds. Prominent Bitcoin advocates and corporate treasuries are also doubling down. Michael Saylor, the CEO of Strategy, formerly MicroStrategy, is famous for his company's strategy of converting its cash reserves into Bitcoin. Recent reports indicate that his firm has once again purchased a massive tranche of over 10,000 BTC, reinforcing their unwavering long-term belief in the asset. This is smart money in action. These large, patient investors are not trying to time the market on a day-to-day basis. Instead, they have a long-term thesis and see any price dip as a discount, allowing them to add to their positions at a cheaper price. However, and this is the crucial point right now, even this significant institutional buying has not been enough to stop the bleeding. The selling pressure from the broader market, driven by those macroeconomic fears about Japan and global stocks, is simply too overwhelming at the moment. It's like trying to fill a bucket with a cup while someone else is emptying it with a fire hose. The buying from the whales is providing some support and likely preventing the price from falling even faster, but it can't single-handedly reverse the powerful downtrend created by global risk-off sentiment. The market is currently in a tug-of-war between patient, long-term accumulators and panicked, short-term sellers. This dynamic creates a very confusing picture. On one hand, the fact that huge companies are still buying is a massive vote of confidence in Bitcoin's long-term future. It suggests that the fundamental value proposition of Bitcoin as a store of value is stronger than ever. On the other hand, the short-term price action is undeniably weak and scary. This weakness is also reflected in the stock prices of crypto-related companies, with firms like Strategy, ticker MSTR, and Bitcoin mining companies like CleanSpark, ticker CLSK, seeing their shares fall even more sharply than Bitcoin itself. For now, the sellers have the upper hand, and the big question is how long the institutional buyers are willing to absorb the selling pressure before they, too, decide to wait for even lower prices. So, with all this chaos, what should the average person do? The number one rule in these situations is simple. Do not panic. Emotional decisions are almost always the worst decisions in investing. Selling everything in a fit of fear after a price drop is a guaranteed way to lock in your losses. Remember that volatility is the price of admission for the crypto market. We have seen dips like this before, and we will certainly see them again. The key is to have a plan before these events happen. If you believed in your investment at $90,000, you should ask yourself if anything fundamental has changed about the technology or its long-term potential just because the price is now $87,000. For Bitcoin, the answer is no. My advice during turbulent times is to focus on quality. This is not the time to be gambling on speculative, low-utility altcoins or meme coins that have no real-world use case. When the market tide goes out, those are the projects that get exposed and often go to zero. Instead, if you're going to stay in the market, it's generally wiser to stick with the blue-chip assets of the crypto world, Bitcoin, and, to some extent, Ethereum. These are the assets with the longest track records, the most security, the highest levels of decentralization, and the most institutional interest. They are far more likely to survive a crypto winter and thrive in the next bull run than some random coin you heard about on social media. This is also a critical time to be a student of the market. Instead of panicking, use this as an opportunity to learn. Pay close attention to the upcoming decision from the Bank of Japan on December 18th and 19th. Watch how Bitcoin's price reacts at the crucial $86,000 to $87,000 support level. See what analysts and experienced traders are saying, but always take it with a grain of salt and do your own research. Being informed allows you to make decisions based on logic and evidence rather than fear and greed. Understanding the why behind the market's moves will give you the confidence to either hold through the storm or make strategic adjustments to your portfolio. Ultimately, remember that big moves in crypto can happen incredibly fast in either direction. While things look scary right now, a positive announcement from Japan or a strong defense of the support level could see the price rebound just as quickly as it fell. The best strategy is to only invest what you can afford to lose, have a long-term perspective, and avoid making impulsive decisions based on short-term price fluctuations. Dollar-cost averaging can be a great strategy in a downturn, allowing you to buy small amounts over time to lower your average cost. Stay informed, stay calm, and make careful, deliberate decisions. That's how you survive and eventually thrive in the roller coaster world of crypto.